hell is that?
It's a bear.
At the start of the year, the prevailing mood in the oil market was not just one of gloom and doom, but of catastrophe, as the oil price had sunk below $30, skidding by the early February to virtually touch $25, a period during which many prominent analysts and investment banks such as Goldman Sachs, all of whom were bearish on the prospects for the oil price this year, some even suggesting that the oil price could sink to as low as just $10 at Standard Chartered, which meant that the oil producers, large and small, the frackers, and even a string of nations such as Russia, Nigeria and Venezuela amongst others, were on the fast track towards going bust as their oil profits that financed their state spending budget deficits evaporated. Well, barely 4 months on, and the oil market has gradually transformed from that of imminent $10 apocalypse to one of hopeful recovery, as the oil price has clawed its way back relentlessly through a series of critical levels of first $30, then $35, $40, and most recently popping back above $45 to stand at a high for the year of $48, nearly doubling in 3 months. And now all those who failed to see this coming are now forecasting higher prices, i.e. one of the biggest oil bears of the year, Goldman Sachs, now reckons that the oil supply glut has evaporated and oil prices are going to reach, wait for it, $51. Wow, crude oil has already risen to $48. These are the same fools who have been banging the drums of all year for a sub $20 oil price, but now after the oil price has doubled are proclaiming themselves as being bullish. This illustrates an important point. Goldman Sachs and the rest are nothing more than snake oil salesmen. They clearly can't make money trading as you and I understand it to be, for if they did, they would be back to being just as bankrupt as they were during the financial crises. Instead, they make money by doing dubious deals such as that which bankrupted Greece by means of hiding their debt. In terms of my oil price forecast for 2016, and my in-depth analysis of mid-January forecast expectations for the crude oil price to bottom by early February at approximately $25, the actual bottom came in at $26 and within the time window for a final bear market bottom, as this video excerpt illustrates. The overall picture being painted by this analysis is expectations for 3 trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range followed by a second retesting range and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within 3 distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December to target an end-year price of approximately $48 as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however, the long-term trend given the likes of climate change is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much of their oil out of the ground as possible and sold off before they run out of customers. The current crude oil price of $1.48 is trading at a new high for 2016, which is set against my trend forecast of $1.45, or where I expected the crude oil price to be by this time. Therefore, with little deviation against the existing forecast, then I see no reason to perform an in-depth analysis of the oil price at this time, as I expect the oil price to continue trend higher towards its ultimate late 2016 target of about $1.60, well above its low of $1.26. In terms of what is probably going to happen next, that my trend forecast suggests that the crude oil price is about to enter its time window for a correction, probably following a failure to break above or hold $1.50. That should trigger a correction back towards $1.40 by September, which would set the scene for oil's next leg higher towards $1.60. I'm sure the correction will once more bring forth the doom merchants to proclaim that the oil price rally for 2016 is over. In terms of the implications for the stock market, ultimately a trend towards $1.60 this year should coincide with a new all-time high for the stock market, which has remained my consistent view all year. The correlation between the oil price and the Dow shows that stocks in terms of trend have outperformed the oil price for most of the year, only deviating from the correction this month by falling whilst the oil price rose. Given that my oil price expectations are for a correction towards $1.40, coupled with a current negative deviation for stocks, then this suggests that the stock market correction has further to run. However, remember that any decline would still be a correction, as I'm not seeing anything to change my consistent year-long view that the Dow will set new all-time highs this year. So what's left to determine is how low could the Dow correction go. Whilst my last Dow analysis of 30th March expected the stock market to undergo a correction of about 5.5% or 1,000 Dow points starting early April. Therefore, my forecast conclusion is that whilst the Dow is yet to give a technical sell signal, i.e. still in rally mode, nevertheless component analysis is clearly converging towards imminent bearish expectations for the stock market. However, we would still be in a bull market, which implies that stocks are likely to undergo a correction to a range of between Dow 16,800 and as low as Dow 16,500 against the last close of 17,633 over the coming weeks, and ahead of the Fed or another major central bank announcing it's going to print money for election year 2016. Therefore, as the title of this video implies, the bears are going to be handed another noose to put around their necks, who I'm sure will reach their most vocal just as the stock market correction bottoms and snaps higher. However, the start of the correction materialized a little later, mid-April, since which time the Dow has declined from a high of 18,167 to a low of 17,500, or about 650 points, which is about 2/3 the expected size of the correction. Which, given the oil price trend forecast, then the Dow should be on a track to continue the current correction towards about Dow 17,000. Elliott wave analysis. A quick take suggests that the current correction is probably a corrective wave 4 decline, which implies to expect an impulse waves similar to wave 1 following the correction's completion, or a rally of over 2,000 points, which will be more than enough to propel the Dow to a new all-time high. So Elliott wave again confirms the prospects for new all-time highs this year. Trend analysis. The Dow's clear long-standing trading range is between the extremes of 18,000 and 15,500. So the potential is for a severe decline towards 15,500. However, there is little in the price charts to suggest that such a decline is probable. The closest series of support levels are between 17,000 and 17,150, which confirms my early analysis expectations for about a 1,000-point decline. Therefore, the current correction is targeting a decline into this support range. MACD. The MACD topped out late April and has been stealthily unwinding its overbought state since, all without much downside in the Dow, which implies that further downside is limited. Finally, seasonal analysis. The basic stock market seasonal pattern is for a weak January and then for stocks to rally into early May and then down into August. Then after a wobble during September-October to rally into the end of the year. Well, so far the stock market has been following the seasonal pattern quite closely, so it does look like it's a case of sell in May and go away until August or September. Stock market conclusion. The overall picture is for a continuing relatively mild correction to between Dow 17,000 and 17,150, which translates into a drop of about 600 points from the last close of 17,710. However, do remember that this is just a correction that I'm sure will hook many bears who tend to reach their most vocal just as stocks reverse higher, embarking on a new trend towards new all-time highs this year. And do remember to subscribe to this YouTube channel for more ongoing analysis and detailed trend forecasts.